President-elect Donald Trump chooses Jamieson Greer as his next trade chief, a man who has advocated for strategic decoupling from China. A ceasefire begins between Israel and the Lebanese group Hezbollah after weeks of U.S.-mediated talks aimed at ending a conflict that's killed thousands of people. Plus, Unilever's chief executive tells us the company left Russia because it was losing control over its business. Well, we'll bring you our exclusive conversation with Hein Schumacher. Now, let's take a look at the European markets map. Again, there's quite a lot going on. We have a lot of data out of the U.S. This is ahead also of a quiet trading day for Thanksgiving tomorrow. So European stocks definitely declining. If you look at U.S. futures as well, a little bit more on the back foot. The only bright spot for the moment is the FTSE 100. Traders across the board trying to digest Trump's latest cabinet appointments. And there's, of course, this burst of data coming out of the U.S. a little bit later. That could give us an indication, pre-Trump taking office, of what kind of economy we have and what the Fed might do. S&P futures down 0.1%. I would look at U.S. dollar versus, for example, yen. This is the big one because it's led, gains in G10 currencies. So 151.88 were there. Brent crude 73.04, and then the 10-year, the big one, 4.277. So for the conversations that matter and the insights you need, let's get started.
Newsmakers and market movers. This is the Pulse with Francine Lacqua.
Well, good morning, everyone, and welcome to the Pulse. I'm Francine Lacqua here in London. Now, Donald Trump has named two key posts on his economic team. Kevin Hassett is set to direct the National Economic Council. Jamieson Greer is tipped to be the U.S. trade representative. So the announcements come a day after the U.S. president-elect vowed to impose additional tariffs. Now, in a moment, we'll be speaking to Wei Li of Blackrock, but now we're joined by Bloomberg's Jill Dices in Hong Kong to talk about these appointments. Jill, thank you for joining us. So we have most of Trump's cabinet picks now. What does the whole picture paint of what his policies could be?
Well, Francine, I'd say, you'd look at this in a couple of buckets. First of all, I think most broadly, you're looking at a cabinet that, assuming all of these people are actually confirmed to these positions, a lot of them have to be, they're nominated. They actually have to get Senate confirmation. These are people that are, almost broadly likely to agree with pretty much everything Trump has to say. This is a bit of a turnaround from back in 2016 when we saw that first Trump administration was staffed, not just with, a lot of people that agreed with Trump's policies or really were kind of like true Trump believers, but also people that were there as more establishment Republican conservative figures that were there to put a check on Trump. Doesn't really seem like he's got those kinds of guardrails this time around. A lot of these economic picks do seem to be a bit safer in that they're not as, firebrandy as some of those positions, other positions that he's appointed. But broadly, it looks like these are people that are ready and willing to step in and enact Trump's agenda here.
Jill, Trump's pick for trade representative also comes, of course, with a track record on being very tough on Beijing. How's he expected to factor into the president-elect's plans for higher tariffs?
Yes, that's right. So Greer, this is a Trump, administration veteran. He worked as chief of staff under Trump's previous trade representative, Robert Lighthizer. This guy really does, kind of come with that tough on China stance. I think that, when you've got, the preamble to what Trump's ultimately trying to accomplish with China in office just earlier this week when he's talking about raising tariffs on Chinese goods. This guy, Greer, has talked quite a bit, as you mentioned earlier, about, really being tough on China, really trying to enact additional restrictions. It looks like that kind of philosophy isn't going anywhere anytime soon. And this is a pick that, again, assuming that he receives, that Senate confirmation, which at this point in time, really nothing to suggest that he wouldn't. He's got a track record working in government, working in the private sector, really kind of, understanding a lot of these economic principles. It does seem like he's ready to go forward and really enact, further tariffs and kind of do whatever Trump really thinks is needed to, continue to raise that pressure on China there.
Jill, thank you so much for all of the updates. Jill Dices there with the very latest on the Trump administration. Now we're joined by Wei Li, Global Chief Investment Strategist at Blackrock. Wei, thank you for joining us. You must have been so busy just to try and figure out what kind of policy tariffs we could see. If you look at tactically what's changed over the last 3 to 4 weeks, are you expecting tariffs? Does that change your asset allocation?
Well, we're risk on for now in our asset allocation, but one of the key signposts that we're watching out for is tariffs-related volatilities. Right now, markets are hoping for bilateral negotiation type of tariff announcement. But if we get close to a place where we're talking about across-the-board tariffs, I think that would be a wake-up call for risk assets, for equities and credit alike. But there is also the hope that market reaction to announcement could act as a counterbalancing feedback loop for the Trump administration, incoming Trump administration. So there is that consideration as well. But for now, we're risk on, but things could change.
Wait, what's your take on dollar? Again, does the dollar continue, rallying from here, or does the Trump administration take steps to try and lower it?
Well, Trump would love a weaker dollar, but the policies around tariffs, around that then leads to higher inflation, actually would also lead to a stronger dollar. Dollar is ultimately driven by, number one, real rate differential, number two, risk sentiment, global risk-taking sentiment. And right now, currently, both would be supportive of a stronger dollar. And it's also highly correlated with U.S. government bond yields as well, and we see that going higher rather than lower, especially on the long end. So dollar may stay elevated at these levels for a while.
Wait, is there a danger? I mean, we focus so much actually on what Trump does next, on how he goes after China, on his policies also against Europe. Is there a danger that the market misses some of the big disruption picture on the way AI is changing, also on climate change?
Which is why we constantly remind ourselves, and also in all the publications that we put out, that it's important to not lose sight of the bigger picture, the fundamental picture, and the fact that we're in an environment of transformations. So there's a lot of focus around the next announcement. I wake up to Truth Social and X before I even check Bloomberg, which is going to be my routine for the next 4 years.
I need to be sedated. I mean, this is not true. Certainly, we all do.
At the same time. But the bigger picture is that this is a potentially unprecedented moment of transformation, because we have AI revolution, we have the low carbon transition, we have geopolitical fragmentation. And if we add up the capex spent for all these transformations, we're talking about a quantum that is comparable to previous industrial revolution, only that it is happening faster. So the build out for AI infrastructure, AI data center represents huge opportunities that we want to lean into, regardless of the near-term ebbs and the flows of the cycle and also announcement coming from, well...
And again, that's so smartly put, but if you look at some of the fragmentation, does it change where data centers will operate and be built in?
It's absolutely a consideration, which is why we believe, even though there is the longer-term hope that AI-driven productivity gain can relieve supply constraint and be disinflationary, in the near term, the duplication of supply chain, the demand for pent-up demand for energy, the need for chips actually means that the AI revolution is inflationary in the near term before it becomes disinflationary. But every phase of the AI build-out, we're talking about, number one, the build-out phase, number two, the adoption phase, number three, the transformation phase. There are lots of opportunities for us to lean into, and concentration is a feature, not a bug, of AI revolution.
Wait, if you have inflationary AI in the short term or medium term, plus possible tariffs that are inflationary, do we see rates higher for longer from the Fed?
That's absolutely right. But markets have actually come around to this high for longer framing that we have held for most part of this year. If you look at market pricing, policy rates for the end of 2025 is expected to stabilize slightly below 4%. Our expectation is 4% in terms of kind of the terminal rates. So we're getting there. So high for longer is now not a contrarian view. It's very much the consensus view. We need to think about positioning portfolios for high for longer, and private markets play a bigger role. And equities, actually, nominal earnings, equities could also be well positioned.
Where do you see China in 3-4 years? So for me, it seems very difficult to decouple, like maybe some of the Trump nominations have been saying in the past that they'd want to do. But at the same time, there are people that believe that Donald Trump will want to deal with China, and that at the moment probably seems far-fetched.
Yeah, China is right in the center when we think about kind of the tariff implication globally. Right now, Chinese economy, there are talks of potential further stimulus. We're looking at December, there is the working conference, and then in March there are signposts that we're watching out for as well. But the bigger picture is that Chinese economy is stabilizing at a lower rate, right? We're talking about an environment where consumers are still weak, and now they're likely going to be further headwind to the export part of the growth engine. So over the longer term horizon, we're talking about Chinese economy settling around 3% in terms of growth level, which is not that much better than developed market economies. So the longer term picture is a little bit more challenging, but there could be tactical things happening because of the influx of news and to what extent it's priced in markets.
Wei, thank you so much. There's so much more to talk about. We'll talk about Europe next, maybe a little bit of French budget and German elections. Wei Li from Blackrock, of course, stays with us. Now, Dell and HP shares also lower in pre-market trading. Both companies reported quarterly results for their PC businesses that actually missed estimates, suggesting a stall in market recovery. Now, PC makers had hoped that new machines with AI capabilities would spur demand. You can see Delta pre-market, or Dell pre-market, not Delta, Dell Technologies pre-market down almost 13%, HP down 9%. CrowdStrike also falling pre-market. It follows a weaker than expected earnings forecast from the cybersecurity company. Numbers disappointing there. Watching for signs that the firm had recovered from a flawed update that crashed computers around the world earlier this year. That stock pre-market down 6%. Coming up, French bond risk rises as politicians stand off over the country's budget. So we'll have plenty more on that story next. And this is Bloomberg. Welcome back, everyone. The conversations that matter, the insights you need. This is The Pulse, and I'm Francine Lacqua here in London. Now, French bond risk has risen to levels last seen during the euro area debt crisis in 2012. This comes, of course, as politicians stand off over the country's budget. Now, we're joined again by Wei Li, Global Chief Investment Strategist at Blackrock. Wei, thank you so much for sticking around. The concern that a lot of, I guess, strategists have for Europe is that you have political factors that make it very difficult in France and Germany, where we're going to see elections in February, to find a solution to domestic issues, including budget, spending, and some of the other issues, coupled with possible tariffs with, Donald Trump arriving in the White House.
Well, it's hard to like European equities from a top-down perspective because of what you're talking about. European equities, European companies just exited a long stretch of earnings recession recently, and you look at the PMI data recently, that was shocking, really seemingly decoupling from the US in particular. Now, having said that, there are pockets of opportunities both within European equities, so we're looking to identify companies and sectors that have more manufacturing presence, for example, in the U.S. and less susceptible to tariffs headlines. We're also looking to identify value opportunities in European credit in particular. You think about kind of the quality adjusted, rating adjusted credit spread. European credits are more attractively valued than their U.S. counterparts. So from an income perspective and spread perspective, they look relatively more attractive. And then the last thing I would say is that European government bonds we favor, especially core European government bonds, because we do believe in the context of weaker growth, the ECB will have to go further than the Fed. We're talking about terminal rates for the Fed. I talked about earlier 4%, close to 4%, but for ECB, we're looking at close to 2%. Markets are kind of already there, but this divergence of policy should support a European duration in particular.
Wait, do you see a lot of the European companies, and I've had a couple of conversations with maybe some of the big company chief executives that are at pains in explaining that they're very present in the U.S., that they want to make sure that, the U.S. incoming president knows that they're very U.S. based. Are we going to see manufacturing actually leave Europe to be more present to the U.S. to then sell to other markets?
The actual reshoring is going to take time.
Right.
It's going to take time. But already we see strategies playing out, identifying companies that already have manufacturing presence. Like our systematic colleagues are combing through LinkedIn data, are combing through their prop data to try to identify companies and then aggregate on a sector level to understand which sectors could be more susceptible, could be more resilient in that context, that could benefit from what the Trump administration previously kind of talked about in terms of tax relief for foreign companies that bring their manufacturing onshore. But it is a selective story when it comes to European equities rather than a top-down, across-the-board story. You look at European financials, which we have liked, that continue to do well in this rate environment. You look at industrials, we also like. So we have to be selective in an economy that is currently best characterized by weaker growth and continued political uncertainty.
I mean, do you have to also choose where they're based in terms of headquarters because of changes in taxes? As a lot of these economies, especially in Europe, need to probably raise taxes to make up for some of the spending that they did during COVID.
Yes, I think so. So in terms of the domicile, we got to consider that, but we also got to consider where they derive their revenues from, right? So if you derive a large part of your revenue from the US, then you're more kind of vulnerable to the announcement than if you're actually very, very global in nature, in which case the bilateral, the tariffs kind of announcement may not hurt you as much. So it's a very complex kind of analysis that we look at, but from a bottom-up perspective, almost on a stock level, but certainly on a sector level, is how we are thinking about approaching European equities that on aggregate have lagged the US, and given the low starting point, we're not expecting on aggregate European equities to catch up.
And where do you put the UK?
UK, currently we have an overweight.
Okay.
Currently we have an overweight because it is more resilient from the tariffs announcement, from a composition of the revenue perspective. Now, having said that, UK economy is also not doing so well, and the budget, yes, it is expansionary, but the benefit of the UK budget may take time to play out. So the UK overweight that we have currently, it is very tactical in nature. It could change. I have greater conviction on the Bank of England. So gilts over UK equities, even though we're overweight in both, because we expect the Bank of England to cut further. Markets are currently pricing the BOE rates to be finishing close to 4, but we think that it should be close to 3.
So interesting. Wei, as always, thank you so much for joining us. Wei Li, their Global Chief Investment Strategist at Blackrock. We talked about France, UK, the US, and China. Coming up, a 60-day ceasefire between Israel and Lebanon-based Hezbollah is now in effect. So up next, we talk geopolitics and the implications for the Middle East. This is Bloomberg. A 60-day ceasefire between Israel and Lebanon's Hezbollah is now in effect. Now, overnight, Iran said it welcomed the deal and reiterated its support for Hezbollah. Meanwhile, Israeli Prime Minister Benjamin Netanyahu said the deal would allow Israel to focus on, quote, the Iranian threat.
I am determined to do whatever it takes to prevent Iran from obtaining nuclear weapons. I have said many times that a good agreement is an agreement that is enforced, and we will enforce it.
Well, Jumana Barsecha joins us now from Dubai. Jumana, so what more do we know about this?
Well, the truce has been effective now for about 7 hours. There were reports and footage of many Lebanese people celebrating. It comes after a night of very heavy airstrikes in central Beirut around 4 key areas. But there you're seeing images of people celebrating on the news. It is worth flagging, Francine, that this is a temporary ceasefire. It is 60 days long. And it will be subject to certain conditions. The first is a gradual withdrawal of Israeli troops from the southern part of the country, in addition to Hezbollah also on their part withdrawing away from the border as well. It stipulates that they need to be 30 kilometers away from that blue line that demarcates Israel from Lebanon. In addition to that, the Lebanese armed forces, the Lebanese army, will be deployed to the southern part of the country alongside UNIFIL peacekeeping troops to monitor the situation, and an international monitoring oversight facility will be set up, including the likes of the US and France, to make sure that there are no infractions. And that last point is key, because if you listen to the language coming out of the Israeli Prime Minister yesterday, there was a caveat. And what he did say is, if Hezbollah breaks the agreement and tries to rearm, we will attack. So what is crucial to the long-term success of this truce is the fact that Hezbollah don't actually rearm and don't start firing rockets back into northern Israel again. So it's still a very tenuous situation, but good news for the region.
Jumana, thank you so much for the update. Of course, we'll monitor this very closely. Jumana Berseche. Coming up, our exclusive interview with the chief executive of consumer giant Unilever. Hein Schumacher tells us about his turnaround drive, the Asian premium market, and how he's preparing for the future without ice cream. This is Bloomberg. Good morning, everyone, and welcome to The Pulse. I'm Francine Lacqua here in London, and these are your top stories. While President-elect Donald Trump chooses Jamieson Greer as his next trade chief, a man who has advocated for strategic decoupling from China. A ceasefire begins between Israel and Lebanese group Hezbollah after weeks of U.S.-mediated talks aimed at ending a conflict that's killed thousands of people. Plus, the CEO of the consumer giant Unilever tells us the company left Russia because it was losing control over its business. So let's start with that exclusive conversation. And Unilever began a turnaround drive last year and has since outlined plans to cut costs, including a headcount reduction of more than 7,000 jobs. The group, which includes brands from Marmite to Dove soap, has also moved to split off its underperforming ice cream unit while seeking growth from condiments, cooking aids, and products for professional kitchens. The chief executive, Hein Schumacher, joined us for a wide-ranging, exclusive conversation where he spoke about everything from consumer spending to premium demand to the possibility of new trade tensions with Donald Trump returning to the White House.
Yeah, I mean, tariffs and protection is always disruptive for businesses that operate globally, and I recognize that. But hey, if it's a reality, then it's a reality. I think what we have been doing over the last few years is, in general, after COVID, we have made our markets in general more self-sufficient. Right. So if you look at, for example, our China market, it's essentially self-sufficient. India, for sure, is. The US is mostly self-sufficient, with some imports though from Mexico, but that is not material to the group. It's not significant, and we have a fairly agile supply chain that, if the situation, if it comes to that point, that we could reallocate our production from those factories to other parts in our network and make the US probably even more self-sufficient. So, hey, we are adapting fast. We're agile. It's not of material impact to the group, but we're obviously watching it very, very closely. I
mean, does it influence your decision on where to cut jobs?
No, at this point it doesn't. No, we have made an announcement on a restructuring program that you're probably referring to in March. 7,500 people, because we felt that was for two reasons. One, we are making the organization ready for a Unilever without ice cream, and that needs to be a lighter organization. And we wanted to be ahead of that demerger and take measures now. So that was reason one. And reason number two, we have changed the structure. I talked to you about strategy and structure. We've changed the structure to be faster, to be able to scale these brands faster across the globe. And when you do that, you need to take the consequences that, hey, it can be a bit, we can be more efficient, and that's what that's what we're doing.
But you worry about unfair advantage for some of your competitors that are based in the US.
Yeah, our competitors, we are based in the US. The US is our biggest market.
But you're not headquartered there. So someone like Pepsi, do they have an advantage under Trump if he puts America first?
No, I don't think so. I think we have been in the US for decades. We can, it's our largest market. We have phenomenal US-centric brands. I talked about prestige beauty, but also brands in well-being, such as Liquid IV, such as Olly on the VMS side and on the well-being side. So, we are in many ways, in that market, we are an American company, and I believe that the US government has every interest to work with companies from overseas who are active in America to promote investment in North America, to care for jobs, to do the right thing for that market, and that's what we're doing.
So you also divested, of course, what you had in Russia. Maybe some of your US competitors won't have to going forward. Was it a mistake to get rid of it?
You know, Russia was something that was a very difficult decision to make. I found that in my last 1.5 years, it was arguably the most difficult decision to make. But I did make it quite soon, in the sense that I wanted to create optionality for us to exit that market, and that was a tedious process. So it took us more than 12 to 14 months to come to that point that we were able to exit. And you know, at some point in September, I felt I had the optionality on the table, and again, it was difficult, but I made the decision to go, not because of the war that's going on right now, but because I felt that the control on our business was coming down. I feel that ultimately, if you're a global company, you need to have control of your operations. We need to be able to review results. We need to be able to get the cash out of the country ultimately. We need to be able to make sure that we live up to potentially international sanctions. We need to be able to control our brands and where our brands travel. And that was something that I felt wasn't enough anymore. And I didn't see a window into the near future where we would regain that control. And that drove the decision to exit.
And talk to me about Ben & Jerry's. So the way that Ben & Jerry's was set up was also having an independent board. Will that still be the case going forward, given actually, you know, a lot of the questions that you've just been telling me about?
Yeah. No, Ben & Jerry's has an independent board, and that independent board that looks after the social mission of Ben & Jerry's only. So it's not a board that looks at the business side of Ben & Jerry's, because that's what we do, but it looks after the social mission that's there. That was agreed at the time that Unilever acquired Ben & Jerry's. It's in the merger agreement, and we absolutely respect that merger agreement. And therefore, the new ice cream company that will be demerged will respect that merger agreement.
Is it tough when, you know, the politics gets into selling products?
You know, I mean, in the case of Ben & Jerry's, look, that brand, we acquired it, I think, at a sales level of 120 million or something like that, and we've grown it to a more than $1 billion brand. It's been growing very successfully, and part of the success of Ben & Jerry's is a social mission. And the way they speak out and the way they speak up, and as long as that fits, you know, the brand, peace, love and ice cream, I'm all for that. It's a wonderful thing to do. You need to be careful that as a company that you don't take political sides when that's not necessary. So, you know, sometimes that brings a certain tension, but I believe it's a healthy tension. They keep us on our toes, and it's a great brand. I love it, and I'm sure it will be successful going forward.
Well, that was Unilever Chief Executive Officer Hein Schumacher, also speaking to me about the Asian premium market and consumer spending in the US.
I mean, first of all, on the US consumer has shown to be remarkably resilient after COVID. Now, US savings levels are a bit lower, and when inflation comes in and so forth, you see that it's slowing a bit on the upper end. But overall, the US has been growing pretty well. If I look at China, on the other hand, where the luxury market has flourished for a number of years, there I see a significant trading down in China. And I believe that's going to last for at least 2 to 3 years, if I look at the fundamentals of the economy. And we are less exposed in that, but we do see headwind also in our categories. For example, we're a market leader in hair care. We do see pressure on the higher end brands and products. If I look on the other hand at Southeast Asia and India, hey, it's a positive story. And I want to conclude on that. If you look at Europe, Europe has been the big surprise for many companies this year. You know, the European consumer, contrary to the US consumer, has actually saved quite a bit. And we Europeans, we continue to save. And that means that our ability to buy premium products and something that we really like to have is pretty big. So we've been growing actually very successful in Europe for this year, high single digit in quite a number of categories. And it shows that if you come with the right ideas, bigger innovation and good products, that are on the premium side, there is a great market in Europe.
But so why is there a little bit of weakness in beauty premium in the US? Is it the product mix, or is it just that consumers are trying to adjust to the new reality?
Yeah, I think consumers are adjusting a bit to that new reality. As I said, I mean, savings have been depleted a bit after COVID. So you can see that, that's number one. I think At the same time, the masstige segment in the US has grown quite a bit. So if you think of the tiering in the market, there's that prestige beauty part, then the part that we call masstige, which is that sort of price tier just below, and we're seeing that grow very fast. So the consumer in the US overall is continuing to trade up a bit, but probably not so much more at the very high end at this point.
Talk to me about India. So this is one of your big growth plans for India. You have a delisted company, and then you'll have another part of that, right? That's also delisting. So you'll basically have two entities in India.
We have two entities, but they're both listed in India, and we have a majority share, and therefore it is a subsidiary of Unilever, and it's a phenomenal asset. If you think about it, we are the number one in all our categories in which we play. We're in 85% of Indian households. We've in the last couple of years we've gained quite a bit of market share, and even now, whilst the Indian market in the last couple of quarters was a little sluggish, we've held on market shares and we gained a bit. And we believe that the mid-term opportunity in India and the long-term opportunity in India is arguably, it is the number one opportunity globally. Just because of the size of the market, the number of people participating, but also given the GDP development. We believe that currently GDP is around 2,500 per capita. We believe that's going to grow to approximately 4,000 in the next 8 to 9 years. Only that increase, if you leave everything else constant, it means massive opportunities in our laundry business when people move from hand washing to machine washing. It means big opportunities in hair care. It means big opportunities in shower gels and the way people take care of personal hygiene and so forth. So I'm very excited about that opportunity, and I can talk about it for a long time. But yeah.
But so these are basically two listed entities. Does it mean that you could also buy more? Some of the local competition is actually quite powerful. They're quite amazing. So could you buy any of them?
Well, look, we have actually made acquisitions in India in the past, and we will always look in India because it's such an important market for us. But at the same time, we have a phenomenal portfolio of brands, and I want to be careful that we're not fragmenting stuff further, but that we actually grow what we own. And I think we are playing now in India essentially in all price tiers. If you look at hair care, for example, we're 4 or 5 times the next competitor, and we play the whole price piano with Tresemme, with Dove at the higher end, with Tresemme being there, with Clinique being there more on the value side. So we believe we can serve the Indian consumer with our current portfolio extraordinarily well, and that's what we want to do.
What about Indonesia?
Indonesia has been a long-standing issue for the company. It's very different than India. We're also listed in Indonesia, but it has been a long-standing issue. And I believe if you really take a bit of distance, the company was surprised by a local competitor coming in at cheaper prices, and we did not innovate fast enough, and we did not market our products and our brands sharp enough to justify that price difference with cheaper priced products and brands. And that's something that's been going on for quite a while. We are resetting that company. And because I'm a big believer in the long term and in the midterm and the long term future of Indonesia, for us, we're definitely not giving up, but we need to take a significant step back, make a significant reset to make Indonesia work for us going forward. And that's what we will do.
Well, that's part of our conversation, exclusive conversation with the Unilever Chief Executive, Hein Schumacher. Now, coming up, more from our interview with the Easyjet Chief Executive after the airline proposed to more than double its dividend payout for this year. More on that next, and this is Bloomberg.
Practically every metric we have been able to report in very strong progress on that. We have had a record summer beating last year's record summer. We managed to reduce the winter losses in the airline, and Easyjet Holiday, as you know, is growing phenomenally and does very well for us. So that's the reason why we're going from the 10 to propose 20% of returns to shareholders.
Well, that is the Easyjet Chief Executive Officer, Johan Lundgren, speaking to us a little bit earlier after the company proposed more than doubling its dividend. Now, he told us Easyjet's package holiday business is growing phenomenally. Now, let's talk to our Bloomberg Aerospace reporter, Kate Duffy, to really understand what's after these headlines and what we should expect from Easyjet. So, Kate, what does it all mean for Easyjet? I mean, phenomenally is always a big word.
It really is. I mean, the headline news this morning was obviously the dividend doubling. This is something that investors are going to be so happy to hear. And also the fact that, you know, this kind of shows growth and confidence in the airline from this year and also going forward. They had a record summer this year and they're expecting to get lots of bookings in Q1 next year too. And obviously, as you said there, Easyjet Holidays business is growing phenomenally as well. So that's something that they're going to continue to try and expand.
So, Kate, are we traveling differently? I mean, how does EasyJet compare to, for example, some of the other rivals, low cost in Europe? But do we travel more since COVID?
I mean, it really varies. We had a massive ramp up in demand post-COVID. That was something that we saw this year. We've sort of seen a normalising of demand, so it's kind of back to where it used to be. But, you know, the thing with EasyJet is that they've got an Airbus fleet, an all-Airbus fleet with CFM engines, so they're not impacted by the supply chain difficulties that perhaps Wizz Air and Ryanair, their competitors, would be.
If you were to give a report card to the EasyJet chief executive, he's been, in charge 7 years. How's he doing?
Yeah, he's done really well. He's had lots of challenges, but also lots of successes. He's obviously taken over parts of Air Berlin, which has been a success. Also, he steered the airline through the pandemic, so that sort of saw a lot of staff layoffs, but then they rehired staff. They've done a massive aircraft order in recent years. And he's also launched Easyjet Holidays, which, as we've seen today, has really grown. So there have been lots of different challenges and hurdles for him, but he's left a good legacy. He's worked in the travel industry for about 30 years. He previously was at TUI, so he's got a good amount of knowledge. And, yeah, we're just waiting to see where he's going to go next.
Yeah, and what are we expecting from the new chief executive?
So he's currently working on the co-strategy with the rest of the board. So we're not expecting too much of a change. He said today that he kind of wants to enhance. He sees lots of opportunities for EasyJet, being in EasyJet Holidays and just the airline itself. He sees growth, he sees opportunities. That could be in the UK, but expansion in Europe could be a possibility as well. So no obvious changes as of yet, but yeah, we're excited to see where it goes.
More to come. Kate, thank you so much for everything. Kate Duffy there, Bloomberg Aerospace reporter. Now, to some other stories making news, and Air France KLM is reportedly in talks to buy up to 20% stake into Spain's Air Europa. Now, the Spanish paper El Economista says the deal could be worth more than 100 million euros and will not require regulatory approval from the EU. Rival IAG abandoned its Air Europa pursuit after the EU pushed back on concessions to clear the deal. Shares in Grifols are sharply lower in Madrid after a Bloomberg report that Brookfield Asset Management is understood to be preparing to walk away from a plan to acquire the Spanish drug maker with disagreements on valuations. Now, earlier this month, the Grifols board rejected an indicative price offer from Brookfield that valued the company at $6.8 billion. The Grifols family, which owns around 1/3 of the company, says it will not support a new bid by a third party to take the company private. Coming up, the European Parliament is set to vote in a new team of 26 commissioners. This comes against the backdrop of Europe preparing for the return of Donald Trump to the White House. So we'll talk about the team, we'll talk about tariffs, and we'll talk about the economy. We're live in Brussels next, and this is Bloomberg. The conversations that matter, the insights you need. This is a Pulse. I'm Francine Lacqua here in London. Now, the European Parliament will vote in a few hours' time to confirm Ursula von der Leyen's team for her second term as head of the European Commission. The vote should see them ready to start work at the end of this week, with key challenges to be faced, not least the return of President Trump. Well, Kevin Whitelaw, our Brussels bureau chief, now joins us. Kevin, thank you for joining us. So what challenges does the Commission actually have coming ahead, apart from Trump, or is Trump the big one?
Well, Trump is a big one, and obviously that's going to probably end up actually being one of their most urgent tasks because the president-elect is expected to come in and begin executing on a number of his promises, including tariffs. But the commission's already been involved in complicated trade negotiations and tussles with China, and so it's going to have to balance potential trade confrontations with both of those countries, even as it tries to work to boost the bloc's lagging competitiveness. And that's going to end up being what the actual overarching task of this commission is figuring out how to keep Europe from falling further and further behind in this economic competition at a time where there could be a lot of turbulence in in sort of the normal trade relationships.
So, Kevin, talk to us a bit about some of the major players for von der Leyen's next commission.
Yeah, I mean, I think there's obviously 26 commissioners making this up from all the different member countries. The Teresa Ribeiro is probably going to be one of the most interesting to watch. She's going to be an executive vice president dealing with competition, so antitrust policy, but also climate policy. So she's going to have a pretty sweeping portfolio and is expected to play a major role in these decisions. Kaja Kallas from Estonia is someone we're going to be watching. She'll be the new foreign policy chief for the bloc, and she comes in with a very strong set of experience dealing with the war in Ukraine, which had been right on the borders of her country. And then a commission veteran, Maro Sefcovic from Slovakia, is going to be the new trade chief, and he's going to be the one who has to inherit a lot of these complicated negotiations with China, with the U.S., and also potentially with the United Kingdom as both sides try to explore whether there's actually a possible reset in relations.
Kevin, thank you so much. Kevin Whitelaw there in Brussels. Now, a couple of stories, corporate stories we're watching out for, away from everything that's politics. Dell and HP shares both lower in pre-market trading. Both companies reported quarterly results for their PC business that actually missed estimates. That's suggesting a stall in market recovery, while PC makers had hoped new machines with AI capabilities would actually spur demand. So you can see Dell Technologies down 12%, HP down 10%. Then the other story we're watching out for is CrowdStrike, also falling pre-market. It follows a weaker than expected earnings forecast from the cybersecurity company. The numbers disappointed investors, watching for signs that the firm had recovered from a flawed update that crashed computers around the world earlier this year. So you can see CrowdStrike down 5.1%. Now, coming up a little bit later, do not miss our interview with Nouriel Roubini, the Chief Executive Officer of Roubini Macro Associates. That's at 5 p.m. UK time. Up next, Bloomberg Brief, Danny Berger and Manus Krani in New York. There's a lot of data coming out of the U.S. Again, a lot of the focus for officials and for investors is not only what we see from data in the U.S., but actually what Trump's picks mean for some of the policies coming out of the U.S. The president-elect's tariffs agenda definitely appeared to gather further momentum as Trump named Jamieson Greer as the U.S. trade representative, Kevin Hassett to direct the National Economic Council. Greer was intimately, of course, involved in Trump's first-term trade policy decision, and that's changing everything that we're looking at on the markets. Yen 151.44, 10-year 425.95. This is Bloomberg.